Hello, Edward Murray here, and I want to talk to you about hedging your portfolio. So, when you have reason to believe that the market's on a downward turn, and you believe in your portfolio long, and you believe in your positions, you have good, sound, fundamental positions. One of the things that you can do is trade options, and you can look at look at an index. So first, let's look at why I have concern that it now may be a good time to hedge your portfolio. As you can see, this is a chart of all the major index, and you can see I have the Nasdaq here, I have the S&P here, I have the Dow here, I have the Russell here, and I have the VIX here. And as you can see, I have major sell-off, except, we'll see what looks like the Dow may be turning at the moment. I have major sell-off everywhere except the VIX. And I don't expect to have major sell-off on the VIX because the VIX is directly correlated with the S&P, and you'll see it with the same thing. You'll see the similar correlation with the other index. Meaning, when the S&P is down, the VIX is up because the VIX is measuring fear in the market or volatility. So this means that there is more volatility, and you can see it played out here. So one of the things that I will do to hedge my position is I'm expecting downward movement in the market, but I love my positions. And downward movement means my portfolio balance will erode, but I'm not ready to give up because in my case, I have some stock and I have some long, which are long-term option contracts that I believe are fundamentally sound. So what I'm going to look to do today, and we'll see, we'll gauge how the market goes a little bit later. But one of the things I'm looking at is trading a VIX option. So the way you would do that is, let's take a look at what the VIX looks like. So here's a chart of the VIX, and you can see I have some Fibonacci's here. You could see the VIX was in a consolidation period here, and you could see that my study here is showing all these red dots in a tight window. You can see it was in a consolidation period. But now I'm starting to get some upward trend, meaning there's fear is growing, right? So the VIX is an index which I could trade. I could buy options on. Now, a little history about the VIX. The VIX, unlike uh, other options, the VIX trades every Monday. I'm sorry, every Wednesday, and it also you can't be assigned the underlying security. Meaning, a buyer can't say to a seller, "I want to exercise this option." It cash settles. So the contracts will expire. The last time to trade the VIX is the close of business day, the day before, because it will settle the morning of Wednesday morning. Um, you can still get some price action from Wednesday morning, but know that you don't have to let it expire if you don't want. It will settle, or you can close it out before expiration. You have that option. What I'm going to do is I'm going to look at the next. So today is the 21st. There's nothing to do there. You can't trade those anymore. But I will look at the 28th. So the implied volatility is 125%. And market makers are expecting that the current price is going to increase or decrease by 4 points. Currently trading at 29.8. The market makers think that this stock can either get down a little south of 25 or a little north of 33. So with that in mind, they're thinking 4 points. So anytime you make a trade, you need to think about your entry and exit. We know the market is going down, or we believe the market is going down. It's currently trading at my 100%, it pierced my 100% Fibonacci retracement. which is the 29, and I'm going to set a tight support at the 78.6 retracement, which here is 28.5. So for me, if it comes down to 28.5, I'm going to be out of this trade. But I'm going to play this up to, they're saying 4 points, so they're thinking it can possibly hit the 161. Um, my approach in all of this is never to go for 100% profit. So if they're thinking it can hit the 161, that would be 100% profit. If I get 70% of that, I will be very fine with that trade. So 70% of the max profit that the market makers are thinking is what I will look for. Right. So if they're saying it can get another 4 points, 4 times 70% would be, I'm looking for almost 3 points. Right. So it's at 29. That would be somewhere between the 1-to-1 retracement. That would be about 32. So that would be between the 1-to-1 retracement and the 161, just a little bit north of here. So that's my goal, is to get 3 points, because that would be 70% of what the market makers think this could go. I think it's moving up based on my study. The max profit for me based on the market makers is 33. And I'm comfortable. I don't have to get the whole thing. It's okay leaving money on the table. If I get 70% of that, that would be enough for me. So let's structure the trade. 4 points. I'm going to go. So if I'm believing it will get up to 34, and you can structure this however you want. You can see they're relatively cheap. So what I'm going to do is I'm going to get the Delta 67. I like Delta 70s if I'm just buying just straight calls. I like in the money. So I'm going to look to buy the 285s. So this is what I'm going to look to buy. The 285s, they're trading right now between, I'm sorry, I am looking to buy the 285s. And you can see, well, I'm sorry, I'm looking to buy the Delta 67. This is strike price. So here's the range. I'm not going to buy at the top of the range. So I'll look to buy here, and I will go ahead and set up my order, that my stop loss, so that if it reaches, if I get 3 points, if the VIX moves 3 points, I will be out of the trade. So that's what I'm going to recommend. And you could load up, because $3.30 means that you'll pay $330 per contract. So you purchase whatever it is that you can purchase. Because you're not doing this in the spread, your max profit is unlimited, because it can go all the way up to whatever. And in this case, if I did 10 contracts, I would be risking 3,300 if I did nothing and it went the other way, which I won't do that, because you already know I set as my loss that if it drops to 28, I'm out of this trade, right? This, although the average true range is telling me it could move, and you can look here, the average true range tells me it could move 2 points in a 14-day period. I'm only doing 7 points. I'm only doing 7 days in this trade. So I'm going to set my loss. I'm wrong if it goes down, if it pierces my support. So I will set an alert right now to say, if it pierces, if it drops below this number, let me know, because it'll be time for me to evaluate it again. And you can see I have it set up to give me mail or mobile. So let me know. I have my alert set up here, because this is telling me I'm wrong. But meanwhile, I'm going to set my profit margin at 32. Okay. So if I get 3 points on that trade, that's plenty for me. All right. Let me know if you have any questions. But always remember, you go into a trade, you need to know what you're looking for in the way of a profit. You need to establish when you're wrong on the trade. And um, those are very important things to consider. Feel free to ask me any questions.